Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me at the Market Site studio, we have Michael Normyle, U.S. economist at Nasdaq, to discuss why we could potentially be in a higher rate environment for longer. Michael, it's great to see you as always. When I think about this, inflation's the first thing that comes to mind, and gas is over $4 now where I live in New Jersey. Probably because oil's moving up here.
Right, exactly. And we didn't get any relief yesterday when Saudi Arabia and Russia both announced that they're extending the production cuts that they've had in place for a few months now. And so those are going to continue through the end of the year. And it's in total about 1.3 million barrels per day that the production cuts are extending through the end of the year. So, that's a bit of a concern where we've seen that pushed Brent oil prices up to $90 a barrel for the first time this year. And its prices have already gone up 25% since the end of June this year as well. And so that's a bit of a concern for inflation because the downtrend in inflation that we've seen year over year, a lot of it has been driven by lower energy prices. So we've seen that trend reverse a bit in the last few months.
And then we saw ISM Services PMI come in stronger than expected. What does that indicate? What are you looking for within that survey?
Right, so it came in at 54.5 and it was expected to be about 52, but really the point is that if it's above 50, it signals that the service sector is in expansion. And so coming in a bit stronger than expected, and it was pretty broad-based too. So things like new orders for services came in higher, employment came in higher, and really that's a bit of a concern where it might invoke the Fed to keep rates higher for longer because we see if employment in services, which is the biggest employment sector in the economy, is staying strong, then that could potentially keep wage growth up a bit higher than the Fed might want, where they might want to keep rates higher for longer to slow things down a bit more.
So when we put all this together, how is it impacting the equity markets and the 10-year yields?
Right, so in the last couple days, when these two data points came out, the announcement from Saudi Arabia and Russia yesterday morning, and then the PMI data this morning, 10-year Treasury rates are up about 10 basis points, and the major equity indices are down about 1 percentage point. So, it's been a bit of a shift from last week where we saw lower, softer labor market numbers, and we saw rates fall in response to that, and this kind of flipping the script a little bit, where there was some hope last week that we might be looking at maybe not as higher for longer, and then the data this week is kind of pushing it the other direction.
Yeah, I mean, we could see in the chart that you just supplied here that the moves were pretty extreme when taking a look at the futures on these particular data points that you all put together. So do you think that's going to be the trajectory going forward if the data trends remain the same?
Well, it's been a lot of back and forth, right? So I think it is kind of moving at the margin, really. It seems like the expectations for the first Fed rate cut, I should say, is probably sometime next spring or summer, and it's really just whether it falls into the spring or falls into the summer, and it's really these kind of data points where the Fed's going to be more fine-tuning from here than any kind of huge policy shift. But everyone's laser focused on what the Fed's doing.
All right, Michael, appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.